purpose of this video is to provide you with a good high-level overview of something that I'm calling the Seattle method. Let's see. The Seattle method is basically a proven, good practices, standards-based, pragmatic approach to creating provably high-quality, XBRL-based general-purpose financial reports, explained in simple terms. So it's grounded in double-entry bookkeeping. It's basically enables you to create a general-purpose financial report that is machine-readable. The focus of the Seattle method is to prepare a financial report where it is permitted to modify the report model. So if you can modify the report model, you have to control those modifications to keep those modifications within permitted boundaries. And that's what the Seattle method does. So this Seattle method, I used to call it my method. And then I read the book about double entry bookkeeping, and they called that the Venetian method. So I decided I'd call this the Seattle method when I'm creating. So it was created over a period of about 20 years. And what I did is basically reverse engineered US GAAP and IFRS financial reports submitted to the SEC. So my background is in accounting, not in computers. So there's a lot of stuff that I had to learn, and I did learn that, and I applied what I learned to financial reporting, and that's what results is this Seattle method for controlling the quality of digital financial reports. So fundamentally, I'm not going to read this, but it's worth really reading and contemplating. If you think about it, a financial report is information that is created by a company. It's provided to an investor. There are multiple companies providing information, and the investor has to sort through all that information, which is about the financial position and financial performance of an economic entity, and then make some decisions. And to do that, it takes certain things to be in place. And that's what I'm trying to articulate here in this problem statement. You can read that. It's in the document, and it's here. I'm not gonna read it anymore. So I'm just gonna move on here. So here is basically a summary of the problem. You have an information bearer, a company. You have an information receiver, an investor, a regulator. There can be more than one information bearer and more than one information receiver. And you have to send a message from the bearer to the receiver. That message is a general purpose financial report. And in the past, the message has been conveyed using paper. And then it was using e-paper like HTML or PDF or a Word document. And now we're moving into a more machine readable and machine understandable format like XBRL. To do that, you have to have the receiver and the information bearer have to have a common shared view of the world. They have to have common shared inference logic, and they have to have common background knowledge, because if you don't have those three things, then you're exchanging stuff, but the receiver is not going to be able to understand it. So fundamentally, this method is about making this exchange actually work. So financial reporting is a very special kind of business reporting. There are 5 aspects of financial reporting that are unique and should be kept in the back of your mind. The first is that financial reporting is based on the Venetian method, or double entry accounting. Basically, debits equal credits. The second is that those debits are defined as assets, and the credits are defined as liabilities and equity by the accounting equation. Third, you generally have a regulator break down those three concepts or some version of the accounting equation, because there are multiple versions of the accounting equation, into a more detailed set of concepts. That's what a financial reporting scheme does. So articulation is the fact that these concepts are intertwined, they're interrelated intentionally in order to make things fit together. I'll show that a good example of that in a bit. The second is, or the last point is, that there's inherent variability in this model because the standard setters intentionally allow companies to modify the components that are disclosed, the subtotals that are disclosed and the totals, and you can combine things in different ways in order to provide flexibility to the entities that are creating these reports. So, and this is where this Seattle method comes into play. Again, when you move things around, you change the model, you have to be able to control the changes. If you don't, then the model ends up goofed up, and the machine readable reports may be machine readable, but they're not machine understandable. So articulation, this is an example of articulation. What I'm trying to show here is that these different pieces, I don't know if you can actually see the actual pieces, but I have a balance sheet and an income statement and a cash flow statement, a statement changes in equity, and then details that break down, for example, the total revenues on the income statement. And it just shows that these numbers are all tied together. And, basically the double entry accounting model is a mathematical model. It's intended to be tied together like this. And this is an excellent use of computers to perform work. And, I get the feeling that double entry accounting was invented before I know that it was invented before computers existed, but human computers existed, but not machine computers. So this is the perfect use for computer automation. It's hard to get better than the accounting information to computerize or digitize. But to do this, you have to do it correct. This video, I'm not going to go into great detail here, but basically I want to show you that there's the notion of different levels of financial report. At the top, you have level 0, which is basically you have a physical medium like paper, and it's not even machine readable. And then you go down, level 1, level 2, level 3, level 4, level 5, level 6, level 7. You add characteristics, and this makes this information more and more machine readable. The ultimate is if you, it was fundamentally machine readable, it was structured for meaning, with a standard syntax, you used a controlled vocabulary, you provided all the rules that are necessary, and you put this information on a blockchain, and you had a Merkle hash that controls whether the information has been changed or not, or it tell you if the information has been changed or not. And this is where level 7 is the best you can really do, I think I can say. Level 5, 6, and 7 are all useful. Anything level 4, it's possible to do it correct, but you can't verify that it's correct. 3 and above is of no value at all. You can't really exchange information. 3 and above. But the sweet spot is 5, 6, and 7. So a financial report is a logical system. And again, this is all in the paper that I wrote that explains the Seattle method. These are all the models, the structures, terms, associations, rules, and facts. They're all logical statements. And these important logical statements are all organized And a computer can deal with logic. Logic it can be expressed using math, and computers they work using logic, and it's again the perfect type of system. And you can create a theory that explains all this, and that's what I've done, and with the help of a bunch of other people. And that's how you can make these reports machine readable. So, and most people, when they think about these reports, they think about data, but that's not what we're talking about. We're talking about knowledge here, information that is related to other information. And then if you can effectively do that, you can leverage that knowledge and produce insight and wisdom, and use the knowledge that was represented in machine readable form. So a knowledge graph is a way to store knowledge. The reason the knowledge graph is so interesting is that it's intuitively and innately understandable to people. People draw circles and arrows and connect things on whiteboards all the time, and that's all a knowledge graph is. So a financial report is a type of knowledge graph. So here, the knowledge graph that I'm showing is in a form that any knowledge graph can be represented. This is a general knowledge display visualization mechanism. But you can take that same knowledge and organize it so that it looks something like this. This is a knowledge graph also, but it's a financial report, and we did specific formatting. If you took a knowledge graph of other areas of knowledge and put it into this, it wouldn't be meaningful at all. But because the type of knowledge that we're dealing with is so consistent, this works really well, and you can display those knowledge graphs in a user interface that's actually very, very useful to business professionals trying to understand the information. And that knowledge graph, you can operate it within a good old-fashioned expert system. So a knowledge-based system or a rules-based system, this graphic is intended to show the components of such a system. And you see the knowledge graph in the lower left-hand corner, and this explains the pieces. And at the top, you get the business user interface, which is an example is that last slide with the this user interface. That's the business user interface. But you tie these things together, and you can create some pretty incredible functionality and let computers augment the skills of an accountant, just like a calculator helps accountants do math. And there are multiple ways of doing this. I didn't invent any of this stuff. There have been, over the past, 40 years, there have been 3 different approaches to implementing these kinds of systems. One is the semantic web stack. Another is logic programming. And the third is graph databases. They all work. I know of implementations using each of these mechanisms. So that's a quick overview of the Seattle method, and I think I'll stop there.